Hello, welcome back. As I was taking a look at the market news module here in our tool, I noticed this piece of news here. Twitter accepts Elon Musk offer, options bulls pylon. And you will see here Twitter's board accepted Musk's offer of a deal at $54.20 a share. And if you go to a stock analysis chart right here, you will see that the current price is sitting at $52.05 a share, and it's going to be slightly higher from what it's currently sitting at. Now, I have talked about Twitter in the past, and it's a company that is not profitable. You will see it here. It's actually losing money pretty much every year. It's not doing great. Although in 2019 and 2020 it was doing better, yet the recent years it has been doing worse, and that's not a good sign to see. And yeah, the free cash flow is negative here, the net income growth is negative. The revenue, at least it's positive, and that's a good thing, but it doesn't seem to be translating to profit, and that's a very big burden. Now, if you take a look at the stock news here, you will see all over the place that Elon Musk buys Twitter, everything about it, pretty much what's going on here, it's official. There, he's buying Twitter for a $44 billion deal. That's a very lucrative one. Let's take a little bit of a closer look here at what's going on. Yeah, so he will pay for $54.20 a share, matching his original offer pretty much, totaling 44 billion over here. And they actually went through this whole deal on Sunday. Well, they were a little bit, quick with this one, and yeah, they acted fast. It looks like. So they initially resisted. You have heard about it. They actually resisting the Elon Musk buying Twitter. You must have heard on the news that they didn't really want to sell the company, but it looks like the acquisition is going through, and it's a 38% premium that Elon Musk is paying over Twitter's closing price on April 1st, when these news were only sort of like originally known. So it's a pretty steep increase from what the price of the company was. And he did disclose the 9% stake in Twitter back in early April. We knew about this, we talked about this, but we never knew that he wanted to buy the whole thing. Very interesting. And frankly, I kind of like this as a move from Elon Musk. I like this for his overall image and portfolio. This could potentially help with the social network of promoting a company like Tesla, for instance. Although, in terms of an investment in itself, as in an investment in the profit that the company is making, it's actually a terrible one. Why it is a terrible one? We're gonna take a look here. And if I go back to the stock analysis chart and pretty much the metrics here, you will see that the PE ratio is sitting at a negative value, and the same thing with the price to free cash flow here. While the outstanding shares have increased slightly from the previous years, not tremendously, and the free cash flow growth again has been negative, and so the free cash flow to total liabilities is a negative number. And yeah, the finances of the company are not looking great here. The net income margin is negative, what we're seeing here. The returners are not good. So yeah, this doesn't look like a company that you would normally buy here, especially at a premium. And frankly speaking, I totally understand why the board sold the whole Twitter to him. Although I kind of get his idea behind buying Twitter as well. It's gonna be used as a promotion tool that's gonna be free of censorship eventually as well, I'm assuming. I guess this may be interesting news for the world, really, because Twitter was a little bit censored lately, and so maybe now it's gonna be a little bit more free. I hope so, at least. Now, the revenue of Twitter has been increasing, but if you take a look at the net income, it's negative to negative, and it's actually more negative than 2017. And this is the problem, and this is the danger about companies that are not making net income, they're not making profit. I have talked about it in a recent video. You are taking a lot of risk, and notice here we're talking a company like Twitter. It's not like any company, it's a massive company making tons of money. Still, they are profit negative. They are not making profit. They are losing money pretty much. And if we take a look at the balance sheet of the company here, you will see that the total equity has been increasing a little bit, yet they have been getting quite some from shares, from issuing shares for sure. Yet, and again, the increase is okay, it's not bad at all. But the thing is, the bottom line, what are they making in terms of cash flow? That's the question. And you'll see here that they actually lost money. They are losing net income, so are actually net income negative. So they are not making profit. So all this positive free cash flow here is coming from the adjustment from stock-based compensation and depreciation and amortization, pretty much bringing this back to positive territory, because the company is not really making profit. It's actually adjusting this stock-based compensation and depreciation amortization expense and adds that back to the free cash flow statement because it's a non-cash expense. That's what's happening here. Now, the cash from investing activities had to be positive here. I'm assuming they had to sell a few things over here. And yeah, they did still purchase some investments, but for the most part, they sold stuff. And a little bit of paying back debt here, but last year they actually got some extra debt, as you'll see, 1 billion over here. They also got 1.4 billion this year as well, but they did pay back some as well too. And they also repurchased some stock. That's very interesting. Okay. I think that's a little bit expensive to repurchase right now, actually. You always want a company to repurchase their own shares if they are cheap, not if they are expensive. That's also very important. You don't want a company to be blindly repurchasing back their shares for no reason. That's very, very important. Even if it's their own shares, they have to repurchase thinking that it is cheap. They have to know that it's cheap. Otherwise, if they are purchasing something, even their own shares that are expensive, then that's not a good idea for them. Now, yeah, the free cash flow has been positive for a while, and then it's turning negative, down at first, and then negative right now. Not a pretty sight. And if you take a look at the stock evaluation tool, which kind of tells you what the company has been doing in a sort of like a small table here, small and comprehensive table, and you have a little bit larger one here with more details. You can kind of see that even if the company grows at, let's say, 15, 17, and 19% revenue a year, the net income margins here, they're gonna be maybe around, let's say 10, 20, and 30. 30 is probably very, very aggressive here. The free cash flow margin, though, you see some values being positive, but the reason why they are positive is because the free cash flow was negative and the net income was negative in some situations. So this can happen in some cases and actually really, really skew your results. And you will see here net income negative, for instance, and free cash flow negative as well. And you have to be very, very cautious for when that happens, because the free cash flow margin is 170%, but with both values being negative here, this is not what you want to be using, of course, because we want our free cash flow to come from actual profitability. And with all these net incomes being negative, that's not a good thing, of course. Now over here, that's a little bit more indicative. This one is positive here, this one is positive as well. So these two free cash flow margins are way more indicative, and this is what I'm going to be using, like 50, 60, and 70 here. And a 13% annual return is what I typically want to be making out of a company, and of course Twitter as well, because I can make 10% out of an S&P 500 ETF. I have more risk here, I need to be making more money. So let's see if it actually makes any sense to follow through Twitter right now. And hit calculate. And Twitter is actually probably going to go private as well at some point. That's also very interesting to notice. But right now, if you take a look at the projection results here, we are seeing that even for our high estimates, which are very aggressive here, I would think, especially the net income margins here and the potential even the free cash flow margins, we're still sitting at $40, and the current price is 52, and Elon is going to be paying 54. So he's definitely overpaying for Twitter, and it's probably not a very good idea. This is why I would definitely recommend that you stay away from Twitter right now. Follow the news, but I think it's not a great idea to actually purchase the company right now, especially in anticipation of potentially even going private. So yeah, I'd probably stay away from it and just follow what's going on these days. Thank you for watching the video. I hope you enjoyed. Please remember to subscribe and like the video. And if you're interested, you may also take a look at our Patreon page for My Investors Heaven. And you will see whether you actually want to potentially subscribe to our Patreon, and you will be gaining access to our tool if you're interested again. Again, thank you for watching, and I'll see you soon. Bye-bye.